Good morning, everyone. The time now is 11:15, so we'll start our webinar. Thank you for joining us this week's research call. So we have several stock counters that we'll go through today, as well as Singapore REITs Monthly and Singapore Weekly. So without further ado, we'll kick things off with Singapore REITs Monthly. Okay, so in the graph on the left-hand side, we see that the FTSE REIT index, which is the dark blue line, is currently underperforming the STI as well as the Real Estate Developer Index. Okay, looking at the REIT performance by subsector, we see that nothing much has really changed here. The healthcare as well as the industrials continue to lead the pack. They have recouped most of their pre-pandemic prices, while the retail, commercial, and diversified are straddled in the middle, and with hospitality bringing up the rear. In terms of interest rate movement, okay, the red line here is the one that we watch closely. That is the 10-year MAS bond yield, as well as the blue line, which represents the 3-month SOR. So interest rates were relatively stable month on month. The 10-year bond yield is at about 1.37%, and SOR is at 0.19%. Okay. So in terms of interest rate, Bloomberg consensus forecasts that the 10-year bond yield will remain below 2% from from 2021 to 2022, and this is below the 10 and 5-year historical averages. So from 2023 is the year where we will see the 10-year bond yield start to cross that 2% mark. Okay. Now this is the yield spread. So yield spread is the one on is the darker blue line. Okay, so currently the yield spread, the 12-month dividend yield of 4.2% gives us a yield spread of about 2.8%. So this is currently at the negative 0.9 standard deviation level. Okay, and if you look at the forward dividend yield, that's about 5.1%. Of course, it's expected to grow. Dividend yields are expected to grow along with as recovery progresses. And of course, some of the REITs have made acquisitions over the last 12 months, which will contribute in the coming 12 months. Okay, so the dividend yield spread based on forward yields is about 3.7%. So that will bring us the dividend yield spread above the red line that we see here, which is the average. So it'll bring us to about 0.4 standard deviation level. Now moving on to the DPU growth. So this is the DPU growth from 2020 all the way to FY22. So we see in FY20 that most of the REITs were impacted from a DPU standpoint. Of course, the hospitality and retail most affected, as well as your diversified. And moving in onto the new year, FY21, we expect the hospitality as well as the retail to provide, to show some strong recovery. As well as, of course, industrial to continue growing from a lesser impacted base, and diversified as well to show about 16% improvement. So the chart on the right hand side is how we look at our FY21 DPU estimates versus the FY19 levels. So 100% of course would represent the pre-pandemic DPU level. So if you recall earlier in the months, somewhere in January, February, you'll see that actually our forecast for our FY21 forecast for Prime and Manulife would have actually been above the 100% mark. However, of course, as the year progressed and the COVID situation drags on in the US, that actually resulted in some rental reliefs that have actually reduced the DPU levels. Okay. Now moving on into our subsector views. Okay, for the office subsector, we are neutral on the office subsector. we see that there has been some quarter-on-quarter improvements in the Singapore and the US office leasing activity. In terms of net absorption, we see that the red line, which represents the occupancy, has trended downwards. So similarly, net absorptions for the first half of 2021 was negative 0.8 million square feet versus positive 0.6 million square feet for the whole FY20. Yeah. So with that, the industry occupancy slid by 0.7 percentage points quarter on quarter to 87.4%. The rental index grew by 1.3 percentage points, 1.3% quarter on quarter, and the grade A rents reported by CBRE held steady at $10.50 per square foot. So our Singapore office REITs mostly reported positive reversions for the first half of 2021. Leasing environment is expected to remain competitive in FY21 amidst right sizing and fiscal prudence. One of the things that has been pointed out by some of the REITs is that more tenants have been asking for expansion and contraction clauses to be written into their lease agreements. So that just means that, you know, while they have been rolling over their leases or their expiries, they are still a bit uncertain about how their space requirements moving forward. So they would like some flexibility to be written into their leases. Okay. Moving on to the industrial subsector. So for the industrials, this is their fifth consecutive quarter of rental and occupancy growth. Okay, so in terms of occupancy, industrial occupancy grew quarter on quarter by 0.6%. This was lifted, in industry occupancy grew by 0.1 percentage points quarter on quarter. This was lifted by the factory asset class, while the warehouses and the business parts slid by 0.1 percentage points and 0.3 percentage points respectively. The economic data remains positive. So Singapore's PMI as well as the electronics PMI posted the 13th and 12th consecutive month of growth. In the near term, pressure on rents may continue. Demand continues to come from manufacturing and certain IT verticals, which will mop up some of the oncoming factory supply. For biomedical demand, that has also been coming through. It should help to prop up some of the business park occupancy. There has been some market rumors about the potential lifting of data center moratorium in Singapore that might happen in the later part of 2021. So of course that will increase, if that should pass, that will increase the supply of data centers in Singapore. But that of course is still rumored and not confirmed. Moving on to the retail subsector, we are overweight on the retail subsector. Okay. The year to June net absorptions was 12,000 square meters versus 2020's negative 70,000 square meters. Occupancy was unchanged quarter on quarter at 91.5%. So that said, most of the retail REITs outperformed the market with occupancy levels higher than 95-96%. The rental index slid by 0.5%. Suburban rents halted their decline. As you can see in the graph on the left-hand side, the light blue line represents the suburban or the fringe rental index. It was unchanged quarter on quarter. However, the central rents continue to dip 1.4% quarter on quarter. So some of the retail landlords have actually restructured some of the leases with their tenants, as well as some of the leases that were renewed or signed. Some of them include higher percentages of the variable component and a lower base rent. Okay, so this of course is to help the tenants, to increase the risk sharing with the tenants, especially right now when the tenants are still recovering. Okay, so for variable components for some of the new and renewed leases range from 5% to 20% of tenants' gross turnover. Of course, the retail REITs are still expecting the GTO component to be below 10%. Some tenants have opted for the traditional base plus or the higher of base rent and GTO rent structure. So we think that this actually suggests confidence in the tenants' ability to sustain and improve their sales, because they rather have a fixed base rather than a higher percentage of GTO rents. Yeah. So we do expect the REITs to remain supportive of their tenants, and they will provide operational support in the form of advertising and promotions, and of course waiving of online fees. That said, the REITs will be providing mandatory 2 weeks of rental relief. Of course, this was mandated by the Singapore government for the commercial tenants, which of course means the retail as well as the F&B tenants. Yeah. On top of that, some of the REITs have given additional support for the phase 2 heightened alert period. Okay, so this is the F&B index for the this is the 3-year performance of the index F&B as well as the retail sales index. We can see that for the last 3 months, the F&B index was more affected. This was of course due to some of the dine-in restrictions as part of the phase 2 heightened alert. So as of June, the June F&B index performance, it was down by 39% of June 2019 levels. The retail sales index was of course less impacted. The graph on the right hand side, it was down by 8.7% of June 2019 levels. So that said, we expect that once as the vaccination rates rise, and of course as the bans are on dine-in is lifted, we expect a strong recovery for the F&B tenants. Moving on to the hospitality subsector. Okay, so average room rates rose from $93 to $171 from a year ago. That said, that will be the dark blue line here. You can see it is slowly recovering. But however, it is still 57% below July 2019 levels. As for international visitor arrivals, the line in red, that is still 99% below July 2019 levels. Okay. So the RevPAR has increased. However, of course, the occupancy has dipped. It dipped from 66.9% in July 2020 to 51.2% this July 2021. So this is because there has been less hotels that have been reserved or booked by the government for the quarantine stay home notice business. Okay, but of course, as more hotels are taken off from the government business, the room rates have risen, and that of course is what and the higher daily room rates is of course responsible for the slow and gradual recovery of the RevPAR. Okay, according to the Ministry of National Development, more than 90 hotels were booked as of August 2021, up from 70 hotels in May 2021. So the government has of course reduced the number of hotels, as we exited 2020. However, due to the recent spike in, or maybe not so recent, the 3 months ago spike in COVID cases, the government has sort of reinstated some of these contracts, and some of the S-REITs are beneficiaries of these rebookings by the government. Okay. In Singapore, some 82% of our population has received at least 1 dose of the vaccine, with 78% fully vaccinated as of 21st August 2021. And the government has also announced, some of the reopening of borders, starting with a differentiated risk-based border measure. So that basically means that the government will be classifying countries into 4 categories, depending on the level of risk. So the lower risk categories, which is your category 1, they will, for example, they will be exempted from stay-home notice and some of your PCR testing and other requirements, with more requirements added on as the risk levels increase. The government has also, started this vaccinated travel lane for leisure travel, which will commence on the 8th of September, starting with Germany and Brunei. Yeah. So all signs point to a slow and gradual reopening of our borders. In terms of how the various key countries are doing with regard to the vaccination progress, Singapore is currently leading the way. About 82% of our population with at least one dose of the vaccine, followed by United Kingdom, EU, and then the US. Okay. So that pretty much wraps up this segment of the REITs Monthly, and these are our Phillip Securities stock calls. So the REITs under our coverage are expected to deliver between 4.3% to 3.9% to 7.9% of DPU for FY21. Okay. With that, I'll now pass the time on to Jie Hui for Yoma.
Thanks, Nat. Sorry, can you hear me? Yeah. So starting with the positives, next slide, please. Okay, so starting with the positives, overall revenue was in line at 55% of our expectations. This was held up by a 46% year-on-year increase in real estate development as construction resumed at Star City and Palm Estate. That said, F&B and motors also performed better than expected. This is driven by a resumption of food delivery services and the sale of automotive vehicles despite limited credit processing as well as the closure of dealer showrooms in April. In 3Q21, amid the ongoing coup and COVID-19, it is good to note that Yoma's core operating EBITDA remained positive in third quarter, with gross profit covering interest expense. Yoma also paid down around $10 million of gross loans and extended several loans in third quarter. It continues to cut OPEX and defer non-essential CAPEX. As such, consolidated cash balance improved quarter on quarter. For the negative, real estate services revenue came in lower as expatriate residents left Palm Estate. This is partially offset by higher leasing by locals, supported by lower rents, better amenities, as well as security provided by the estate. Next, please. Okay, so in terms of outlook, we are expecting business disruptions in fourth quarter due to the lockdown that was placed from 17 July to 15 August as Myanmar attempt to bring down the number of COVID-19 cases. Only healthcare facilities, banks and shops that are selling essentials, medicines, and medical supplies were allowed to remain operational. F&B establishments can only open for takeaways or deliveries. Therefore, in terms of the impact on Yoma's various business segments, we believe that the bulk of the impact will be coming from Yoma Motors and F&B. This is given that most of the automotive showrooms were forced to close and the inability to get in will likely impact sales. So currently, F&B sales are around 30% below pre-pandemic levels. We think that Yoma's other two business segments, like real estate and financial services, will likely remain resilient. So just to give you some color, construction is still ongoing at Star City despite a slowdown in sales. We will likely be able to see construction revenue coming through Yoma Land. Yoma Financial Services will likely hold up as Yoma is improving the efficiency of the asset base for Yoma Fleet, and Wave Money's monthly average users grew double-digit month-on-month in May after the resumption of 4G network. However, we do think that the people's preference for physical cash will likely affect transaction volumes in the coming quarter. Yoma is also looking at right-sizing its restaurants platform to focus more on KFC and YKKO, and is looking to close 25% of restaurants if they are non-profitable. So for example, Yoma will be closing Leadership Hotpot and Auntie Anne's by the end of August, and we are expecting the overall top line loss to be 1%. On the motor side of the business, Bridgestone Tires also ceased operations as of end July. Yoma has a 30% interest in this associate. So for the closures and we are estimating write-offs to impact trade receivables and investment in associates by about 10% and 5% respectively for fourth quarter 21. All in, we are deriving a lower target price as we roll over our estimates and lower our FY22 book value by 4.6%. This is after accounting for the impact on trade receivables and investments in associate companies. Also, this is partially offset by the higher US dollar, Sing dollar assumptions of $1.36 from $1.34. So all in, we are maintaining neutral on the counter with a target price of 12.9 cents. This is all for Yoma. I'll pass my time on to Vivian for Koda.
Thanks, Jie Hui. So I'll be covering Koda's second half 21 results update. The title of the report is Waiting for Resumption as we wait for the manufacturing operations to resume to normal levels. So first of all, looking at the results in the table on the left, Koda recorded higher revenue and PATMI for second half 21 due to higher export sales to all regions. This is under the manufacturing segment. So if you refer to the bullet points on your right, this is especially so for North America, which the sales increased 81% to $27 million. For the second segment, which is retail and distribution, Koda also saw increased sales and the segment turned around from a net loss of $835,000 in second half of 2020 to net profit of $217,000 in second half of FY21. Next, Koda also saw increased margins. So due to the higher production volume for second half of 21, the improved factory efficiency resulted in lower unit production cost per output. And this basically means that they benefited from the higher economies of scale. On the negative side, FY21 operating cash flow decreased 11% to $7.6 million. The decline in the operating cash flow was due to higher working capital. So we saw that the inventories increased 72% to about $20 million. And this could be due to, as they saw greater demand for furniture, they stocked up on more inventories. For the free cash flow, it also declined due to higher working capital and higher capex, which increased more than 2.5 times to $3.5 million, as the company acquired a land use right and factory building in Vietnam for their expansion plans. Referring to the next slide on the outlook, the graph on the left represents the demand for furniture. So for US furniture imports, for June 2021, it slightly declined by 1% month on month to $5.6 billion. But on a year-on-year basis, it still increased about 55%. And as you can see, it remained largely above the pre-COVID levels. So on the demand side, it is still very strong. However, for the Vietnam furniture exports, this graph is the value of Vietnam furniture exports excluding those of wood. So we are expecting the same trends for wooden furniture as represented by the dark blue bars. The exports in July 2021 was down about 17% month on month, and on a year-on-year basis, it was only up about 1%. We expect this to be largely due to the COVID-19 restrictions that have disrupted furniture production across the country. Next slide, for the updates on the COVID-19 situations in Malaysia and Vietnam, which basically affect their manufacturing segment. So they have two manufacturing facilities, one in Malaysia and one in Vietnam. The Malaysian government allowed manufacturing firms to operate based on full vaccination rates of employees ranging from 60 to 100%. And what this means is basically that if you have 60% of your employees fully vaccinated, then you can operate at 60% capacity. And if 100% are vaccinated, then you can operate at full capacity. For Vietnam, the factories may be allowed to operate at 70% capacity if all workers have received their first dose of vaccination and full capacity on full vaccination rates. As for the retail and distribution segment, the recent surge in COVID-19 cases in various provinces in China sparked lockdowns, mass testing, and travel restrictions again. But the Chinese health officials have commented that the situation is generally manageable. But we are also expecting that the expansion plans for commune in China could be partly affected. So a short conclusion for the outlook is that the demand remains strong, and for Koda, it's basically just waiting for their operations to return to normalcy. Lastly, for the rating, we maintain our buy rating with a lower target price of $1.10 as we roll over our 7x X cash PE target to FY22E. The FY22 PATMI estimate was lowered by 29% to $7 million. The revenue estimates remained relatively unchanged, but the gross profit margin estimate was lowered from 32% to 29.5% as we consider the production disruptions at Koda's manufacturing facilities in Vietnam and Malaysia. So that's all for Koda. Next, I'll be moving on to a quick update on the iron ore prices and China's steel production. So we have been receiving questions regarding this over the past two webinars, and we thought that it would be good to do a brief update on the trends that we have been seeing. Firstly, referring to the graph on your left, if you look at the red line, which represents the iron ore prices, these are the prices for the iron ore imports into China. And the blue line represents Fortress Minerals' share price. So the recent correction of the iron ore prices has been the biggest correction since the prices started rising during the October-November period last year. And since then, Fortress Minerals' share price has also been trending the iron ore prices quite closely. More recently, over the past week, there has been a slight rebound in iron ore prices from about $130 to $150 per ton. And we also saw a similar rebound in the Fortress Minerals share price. And next, we'll be looking at the steel production levels in China. So the expectations of this is also a major factor affecting the iron ore prices. If you refer to the rightmost blue bar, which is the steel production for July 2021, actually the steel production has been falling since May, which is the highest or the tallest blue bar there. And the red line represents a year-on-year percentage change. So with the falling steel production levels, the year-on-year percentage increase has also been declining. And actually for July 2021, the production dropped 7% year-on-year to 86.8 million tons. And this does not seem to be seasonal, as the production usually increases during the mid of the year if you look at the 2019 and 2020 trends. Chinese officials have announced for continued steel production curbs, which is to keep the 2021 annual production level at 2020 levels. So they are hoping for no change. But for the first 7 months from January to July this year, the steel output for China has already increased 8% year-on-year. As such, according to Bloomberg consensus, steel production would still likely increase for 2021, but slower compared to the 6% increase for 2020. So probably at about 3%. In conclusion, it does seem like the efforts by the Chinese government to curb the steel production for various reasons, including reducing pollution, reducing demand on iron ore, which the Sino-Australia geopolitical tensions has also been a factor, has been taking effect. And more recently, there is the tightening of the property market with higher mortgage rates for both first-time and non-first-time buyers, and also tightening of funding conditions for developers, which also resulted in a notable contraction in land sales volumes. But of course, there will be some time lag between such indicators and the actual effect on steel production. Looking forward, we will be monitoring the measures affecting steel production levels and also iron ore production closely. But in the medium to the long term, fundamental demand for steel and iron ore is probably here to stay. It's likely here to stay with the infrastructure plans in the world's biggest economies like US and China to continue. So that's all for me. I will now be passing the time on to Terence for BRC.
Yeah, thanks, Vivian, and good morning, everyone. BRC Asia, a steel reinforcement supplier, reported third quarter financial year 21 results that were in line with our forecast. So in our next slide, we provide a summary of the 3Q financial year 21 results. On a quarter-on-quarter basis, revenue actually grew 21.8% quarter-on-quarter. So this increase was due to stronger order fulfillment, largely in line with our expectations, because second half for financial year 2021 is traditionally a seasonally stronger quarter for BRC. The pipeline also remains healthy with order book steady at about 1.1 billion Sing dollars. We believe expect about half could be fulfilled within the next 12 to 15 months. The credit situation is also stable. The provisions for receivables impairment was better than expected at 1.7% of total receivables for 9 months 21, which was lower than the 3% we imputed in our model. Net gearing, however, rose 4 times to 1.1 times. You can see this on the table here on your left-hand side. Sorry, it's a little bit small, but the table here on your left-hand side, the last row, you can see on a quarter-on-quarter basis, net gearing actually rose 4 times. This is because steel prices remain elevated. So we expect inventory costs and net gearing to remain high in financial year 21 and financial year 22, mainly because steel prices have risen so much over the last few years, or last few months. Yeah. In our next slide, we cover some of the positives and negatives in their third quarter financial year 21 results. In spite of the tighter movement controls from mid-May to end June, the BRC Asia still managed to see stronger order fulfillment, which is a positive because order deliveries went up. Importantly, management also kept their dividend guidance for financial year 21 unchanged. Financial year 21 estimates is for 8 cents of dividends to be paid. So they already paid out 4 cents of interim dividend for the first half. So we expect another 4 cents at the end of the financial year. So when we look at the total dividends to be paid out for financial year 21, it translates to about 5.3% dividend yield, which is quite respectable. The provision for receivables impairment was also better than expected. In terms of negatives, gross margins contracted 60 basis points as manpower costs rise, in line with the industry. So gross profit margin actually tightened. Net gearing also rose 4 times because of increased working capital needs. Yeah, in our next slide, we cover the latest announcement by BRC. BRC Asia announced over the weekend that they are proposing to issue 31 million new shares to Hong Leong Asia Investments at $1.48 a share in a private placement to raise gross proceeds of $45.9 million. Concurrently, Hong Leong Asia Investments will purchase from several vendors an additional 15 million shares at the same price. But also take note, this is conditional on the placement's success. So if the placement don't take place, then this won't take place. But the largest shareholder has really indicated that they will vote. So we expect this whole transaction to be completed within about 6 weeks after they obtain regulatory approval. In terms of positives, this will be a balance sheet boost. If you look at the pro forma effects based on the financial year 20 numbers, you look at the table here on the left-hand side, you can see that net gearing before the proposed placement was about 76.1%. After the proposed placement, assuming that the new shares were issued in financial year 20, it shaved off about 26%. From their net gearing based on financial year 20 numbers. But if we look at their most recent quarter, their third quarter 21 financial results, then net gearing will improve from 112% to 83% if it was completed. So this gives them more options when the gearing is brought down. The new substantial shareholder will also enhance BRC's overseas expansion. Hong Leong Asia Investments will become a substantial shareholder with 20% ownership after the transaction. So that there are obvious synergies for BRC Asia in terms of Hong Leong Asia Investments becoming a substantial shareholder. In our last slide on the outlook and our recommendation on BRC Asia, the resurgence of COVID-19 cases in Malaysia and Singapore continue to threaten the construction recovery for BRC in Singapore, because we get most of our raw materials and resources from Malaysia as well for the construction industry. So the surge in the number of COVID-19 cases, you can see this on the table here on the left-hand side. The surge in the number of COVID-19 cases in Malaysia also presents a challenge to Singapore. And there was also some news last week that Great Earth Construction actually went under, and some of the construction projects are now on halt. So at this moment, we don't see it as anything systemic. Obviously, there's some stress in the industry, but nothing too systemic at this moment. But this just highlights some of the challenging conditions within the construction industry. That said, construction demand is still expected to improve to 23 to 28 billion in 2021 from about 15-16 billion dollars in 2020, according to BCA, the Building and Construction Authority's forecast. In terms of recommendation, we keep our buy on the company because in terms of valuation, it's too cheap with an unchanged target price of $1.79. So this valuation is based on 11 times FY22 PE, which is a 15% discount to its 10-year average PE. On the 15, we apply 15% on account of the uncertain environment. Yeah, so that's all from me. I'll hand over the time to Paul.
Okay, thanks, Terence. Move on to Netlink's first quarter 22 update. This stock is basically everything is very modest because everything is very stable. The positives, at least, was on the non-residential connections. This is basically office, and it was just higher than it was the highest in 6 quarters. Again, these are very small numbers, like 490 again, because the stability is so high for this company. The negatives was just on the residential connections, basically the home connections. We were modeling about 25,000 new connections per year. This is in line with the number of homes built in HDB or even private. But I guess it's only 2003, and we're just hoping that this could still hit our forecast, our model 25. The next is ducts and manholes. It's still small, but the thing is, I guess the notable thing is this is on a structural decline because this is the ducts and manholes where they ran to Singtel for copper wires, and we know nobody uses copper these days anyway. In terms of the results, was within our expectations. FY22 should be stable, but I guess the main key thing would be the regulatory review. If you just to refresh, every 5 years there's a review of the prices that they charge us. The fiber prices, I think the 1380 per household. So the last review was in 2017. The next one, the discussions will start next year with conclusion end of next year. For us, it is quite hard to forecast what will be the changes because there's a lot of moving parts. A lot of these numbers they submit to authorities is also forecasted. The negatives, but we think prices could be moderately lower. I think mainly because of the WACC or interest rates are lower. And even you can also argue that their cost of equity is also lower considering they are more matured now. The offsetting, and also they got more number of connections, so per household, the price should be lower. The offsetting thing is that the regulatory base is still high. I mean, it's a bit technical, but they are given a rate of return for what they invested, and that continues to go up, but because of the capex. But we think moving forward, capex could be a bit lower, and this could actually help sustain the free cash flow. Because for trust, it is not just operating cash flow. Trust pay out their dividends. If you look at the details, distribution available for distribution, it includes the amount of loans. So they actually have some flexibility. If they borrow more, they can actually pay you more. And it's a bit, it's virtually tagged to the amount of cash flow they generated. Yeah, sorry, it's a bit technical here, but I mean, this is how trusts are designed in terms of distributions. No change for us. We still maintain and accumulate with 103. The yield now is about 5.2%, and it's backed by the monthly regulated monthly payments that they get from the 2 million household customers and business customers from in Singapore. Next slide. Next slide. Okay, just to give you some updates on some of the macro news coming up from Singapore. The numbers are still strong. Industrial production. You can see there. I mean, July is stronger than even June, and it's across the board from pharma and even electronics. There's one other data point is just the core CPI. I guess this is only important in October when the MAS kind of reviews the currency, but it seems to be at the higher range of their forecast. So I mean, if this continues and it breaks the range, then there is room for maybe they might have to do that appreciation again. They might kind of raise the level of appreciation for the Sing dollar. Again, this is still early. It's only in October or 2 months time. The next piece of news is I think we all see all in the headlines, the Jackson Hole speech by Jerome Powell. So I think the key messages from him is that the asset purchases will reduce pace this year. So this means that they will buy less mortgage-backed securities and treasury bonds. But the other key message from him is that this doesn't mean that if it ends, that they will start to raise rates immediately. And also the pace, so some of the uncertainties is the pace is unclear, how much they're going to, how long. But I think the base case now is that by November, they will announce they will start reducing the asset purchases. And this should end in May, in middle of next year. And probably rate hikes could be early 23, the latest probably. Other things is just in the US, the numbers are still good. Auto sales, although it's 4%, but no, year to date is 25, so it's still very strong considering the shortages out there. And durable goods is just capital expenditure. Again, a very strong number. So despite the concerns, I think the US numbers are still trending very well. Those are the macro numbers. I'll roughly brief you later some of the meetings that we attended. I think most may have get access to, but at least we will just try to share with you some of the key highlights from these meetings. Technically, we are incrementally positive. I think the taper overhang has been removed. I think everyone was so worried about the taper tantrum. I think the two messages that kind of calm investors, I guess, is the Fed still mentioned that monetary policy will still be accommodative. So they're not tightening monetary policy, so they're still going to be loose. And the other thing is that even when taper ends, it doesn't mean that the interest rates will be increased immediately. So it doesn't decide on the timing. So I think that kind of maybe calmed the market. That's why maybe the bond yields kind of came off a little bit, I guess. We have some webinars if anyone's interested to attend. So tomorrow we have SPH, then the following day is Koda, and I think you can see we also have a Comfort Dalgo for those who are interested to attend. Next slide. Okay, just a very quick look at the cases right now. So globally, it's still rising, but at a lower pace. So that's the good number. I guess the interesting thing now is that hopefully vaccination rates in the US can improve now that Pfizer has become has received full approval from, and so that I think now companies can use this as a reason to you must get fully vaccinated or you cannot return to office. So I guess hopefully this will raise the vaccination levels in the US. Next slide. This is just an update on the cases in Southeast Asia. The good thing, I guess, I'm not sure how they did it, but I think Indonesia, you can see the cases starting to collapse, although still high at 20,000+. But the issue now is the Southeast Asia, you don't see any slowdown in the cases in Southeast Asia, especially Malaysia, Thailand, and Philippines. The good news in China is back to the pre-spike that you saw in May. That was starting to worry everyone, but things have started to calm down. So that's a positive. Next slide. In Singapore, we got this big bounce thanks to the Bugis cluster. I think we got the last 1 week, we got 800, and maybe 1/4 of it came from the Bugis cluster itself. So I think I guess that's the risk of whenever you have any, so long as you got unnamed cases, you're prone to some large cluster. So that's the risk. But the good news is that we only have 6 in the ICU, and we are going to hit 80%. So if you recall, the authorities had three milestones, which includes an 80% vaccination rate by October, and we reached that. So that should mean that there could be more relaxation going forward. Because we're not supposed, at least we're not supposed to be looking at community cases and focus on ICU, and that's kind of stable. So hopefully there will be more relaxation of measures. Next slide. Okay. This is just a quick refresh for everyone. What needs to happen before raising rates? Again, just a reminder, just a mental note. The two key things is maximum employment. They never mention what is maximum employment, but I think most people are thinking of 4% unemployment rate. So right now we are 5.4. So once they hit 4, then there's no more reason not to raise rates. And the other thing is this term called inflation moderately exceeding above 2%. I'm not sure how he actually defines it, but obviously that's already far above 2%. So that criteria has, I guess, been met. Yeah. Next slide. Okay, in terms of, we had a poems webinar with Halcyon. In case some didn't attend, just to inform them what it actually does. So this company is owned 55% by the huge Sinochem in China, the SOE in China. What they do is mainly rubber processing. So what that means is that they don't own the plantations in Indonesia, which is their largest factory. So what they do is they collect all the small rubber lumps from smallholders, and then they will clean it, process it, and then bake it and so forth, and then sell it to the rubber tire makers like Goodyear, Bridgestone. The plantations that they have is mainly in Africa. They have, I think they are a big company. I mean, they have almost 10% share of all the natural rubber that has been sold. 9% have been sold in 2020. I think that one, rubber mainly tire. So the thing here is that if you have a view that rubber price is going to rise, it's at a 4-year high right now. In February there was a 4-year high. How this benefits them, I think that's the key thing. So they have plantations, so that will obviously benefit when rubber prices are high. The second thing is the processing. So that part is a bit harder to kind of to understand. But if prices do rise, what could happen is that volume will be up, and that will help their factories because utilization is higher. And usually when prices are higher, they can get a bit more cheaper inputs because these are all small rubber tappers. And when prices are high, they may not be demanding such they might leave some margins on the table for the processors. Because at the same time, the challenge for processors is that you're not the only factory bidding for all these smallholders. I mean, I've been to their factory, but I mean, so the challenge is that as you buy the inputs to process, there'll be other factories now around the area that are also buying. So, but when prices are high now, all these rubber tappers don't really want, they won't bargain so much, I guess, in the layman terms. And that's how it works. Yeah. Anyway, the outlook for prices for rubber, what happened was in 2010, you can see the big spike. So there's a lot of planting in 2010. And now what you're seeing is that the production, that's why supply is affected, the prices are down because there's a lot of supply coming up because of the huge planting in 2010. But production tends to peak in 12 to 13 years. So on paper, you could see peak production in next year and the year after that. And that, I mean, again, these are all scenarios. That could mean the supply could contract, and I mean, supply could flatten out, and demand continues to rise because of tire usage. So 2022, 23 could be a possible time when rubber kind of rises when the demand supply kind of improves. And on terms of the EV impact, I guess there were some questions on the impact of EV. According to them, it could actually be good for tires when you have EV because EV car is heavier. I have no idea. The other thing is there's of course the EV, there's instant torque, so they would all lead to more wear and tear of tires. Again, this is their scenario. I mean, don't ask me to verify how accurate it is. Okay, but anyway, they've been losing money. They were still marginally profitable in the first half, but I guess the feedback is that, of course, the low rubber prices you can see, and also they made a lot of investments in plantations, and so that is, it will take time for the production to come on stream and help earnings. Okay, next page. Okay, Silverlake Axis. Again, this is just a quick update since we were in the briefing and some may not have attended. But for Silverlake, they are a banking software. I think they have like 40% of some of the top banks in Southeast Asia. And these are core banking solutions. So I think the main message that we got from that was that that the deal seems to be appearing. If you look under the outlook side, the deal seems to be returning. In 2020, they secured almost 270, then 2021 it improved to 350, but a lot of the deals came in the fourth quarter alone. So what it means is that what is happening is that the banks, after holding back on spending because of COVID, right now you see banks spending again on IT infrastructure, and they have this cloud software called Mobius. I won't go into that, but just that the general basic message is that spending is returning for banks, and that should kind of help them moving forward. Next slide. Okay, this is my last slide. This is on Oxley. We don't cover, but we were lucky enough to get into the briefing, so we just kind of update everyone some of the key points. So the table on the right is just all their property development projects. So you can see, if you just focus on the billings, which is basically the amount of revenue they should be recognizing, most of it is still in Singapore, the 1656. So they sold about, they've got like 1.6 billion of property development revenue to be recognized. So let me quickly run through the points. They are a developer mainly in 9 countries. I think the revenue you can see, they're trading probably around book value now. Okay, for the financials, the burden they have is the 100 million interest expense a year. I mean, it's huge, right? 100 million expense a year. So that's what is the thing that's pulling down a lot of the profit. So even though the profit, that's why even though revenue is 1.4 billion, PATMI is only 98 because of the huge interest expense. The good thing is the net debt has kind of maybe eased off a little bit more. I guess the interesting commentary we wanted to check is also on the Singapore resi. So we actually asked, like, are they bidding for land? I mean, property market is so, I guess, so hot right now. But I think their view is that they will not bid because the cost is high. And if they do bid for any land, they probably have to sell it at 2,000 per square feet. And they're just not sure whether, if they launch anything, can they push through past this 2,000 per square feet price? Of course, the other thing is also policy risk if prices keep rising. And also, if they do bid for land now, there are many bidders. So I guess in a nutshell, most likely they'll be like staying away from bidding for new land. I think we all know, I think the delays in construction is causing 6 to 9 months. On the question of why the market is so hot right now, I guess, I think their commentary was maybe fear of losing out due to rising price. And the other thing is that there's an upswing in HDB upgrading. So they gave the example that in Sengkang, they launched 2 projects there around there. I mean, not exactly Sengkang, but they launched 2 projects around there. And they actually initially thought there's a lot of too much supply coming in that area. But because of a lot of HDB there, and a lot of them met the 5-year minimum occupancy period. After 5 years, you can only sell because of the grants. Then they saw that there's a lot of demand. So a lot of people upgraded because they have end of 5 years. And that's why demand there, they soaked up a lot of the supply in that area. I mean, this is just an interesting tidbit. In terms of outlook, you got a 1.9 billion billings. They still have 500 million projects to be launched. And all they're going to do is just raise prices for the whatever that's unsold in Singapore. The main focus for them will be under the future projects. You can see is they're going to be focused on Ireland, 1 billion project, mixed development, and also UK, which is next to their Royal Bond. Okay, but anyway, I won't run through. I think that's more or less it. Yeah, okay. Next, I think that's the end. I think we can go on to questions. Yeah. Thanks, everyone.
All right, thank you. Thanks, Paul, and everybody. So I just want to do some of the technical sharing based on the Q&A provided. So you can see my screen, just type 1 in the chat, and then before I carry on. So just want to make sure that everybody can see my screen. All right, so okay, thanks everybody. All right, so first up of the question is Samudara Shipping, S56. So this stock has been ongoing of a rampage bull run. It's like almost like Union Gas at a time. But if you look at it, price actually, I wasn't confident last week when I shared it because it is like forming a rolling top. But price actually rebounded and then breaks through the resistance, turn support at 0.460 to 475. My highly guess is currently price already has reached the 1.618 extension. That's why there's kind of the selling. So but ultimately our target is 0.540. All right, so either way, if you look at it, price is either going to go straight up with a minor correction, or is going to correct down to the resistance and support at 0.460 to 0.475 on that. So let's see how it goes on that. All right. So for next one is nanofilm. Nanofilm actually I've really ceased to cover again to do any more technical analysis on it. First up, the whole alloy wave count has really completely gone. without even going to wave 5. So technically, nanofilm will likely to be range bound for a while at 3.73 to 4.84 region. Reason being, you can see that the rebound on this support at $4. It did manage to rebound above $4, but you can see that the momentum remained weak. You can see volume has been on the decline. Even though there's a spike up rebound, volume has been on the decline after that, and especially you see that this after the ex-dividend date. Okay, so that's for nanofilm. For Maple Tree, someone asked about is it an inverted head and shoulder or some cup and handle? You may say that this is a cup and handle that's being formed, but on larger scale, this is an inverted head and shoulder. Okay, so price briefly break above the neckline resistance, the upper neckline resistance at $2.92 to $2.96. Furthermore, you can see that there is a bullish flag that which I shared last week. Prices have been ranging last week. So any clue, we have to see price actually breaks above 2.96, preferably above $3 to confirm the upside. All right, so therefore my next target will be around at $3.10. That's my target price one if you refer to my report. And then subsequently at the upper bound at $3.40 if you look at the from the weekly time frame. Okay. So next on, I move up to Sandal Street. Sandal Street has been performing well. He has reached my target of $3.50 since I issued my report. I issue a second continuation report on it based on the fact that there's a cup and handle formation. Multiple testing of the resistance zone 2 at 3.09 to 3.15. Okay, so what is going on for that is there's a bullish flag. Okay, so also it's like a doji, dragonfly doji. If this is a bullish candle, it closed above, is closed with $3.10, then this will be a good news because it will be a morning star. First up, and then it will be a strong bullish reversal signal. Furthermore, if you can look at the 63-day moving average has already crossed above the 200-day moving average, forming a bullish crossover despite it being ranging. This kind of news is very comforting to us. But especially it closed above the 63 and 200-day moving average very tightly over here. Okay, so next one will be Great Wall Motor, which is closely correlated to what I issued this morning on BYD Motor as well. You can look at here, price actually has already closed above the bullish flag. Like the inside bar has really broken up on the upside. And then this is like a continuation pattern. All right, support, resistance and support at 31.90 is being well supported. So we expect some upside to test $40 going forward for Great Wall Motor. All right, some continuation of the what I observed from BYD. BYD opened lower, traded lower today, but price managed to rebound during the lunch hour. So we expect the bullish scenario, which has explained clearly in my report. For those who are interested, you may read from stocksbnb.com. All right, compared to Great Wall Motor, it has already broke up. But BYD 1211, okay, still struggling to break above 280. But I believe that this short-fall retracement with the bullish flag and the rounding border is likely to break above the resistance. So it will be a reenactment of what happened to Great Wall Motor. All right, leading has been doing well. Finally has broke above the constant reversal at $98.15. So I expect some more upside to break the $100 major psychological resistance to continue to trend further up on the upside. All right, Starhill Global REIT, this is just no one asked, but I think that I'll just add on. Reason is because prices have been trending up, trending lower. So if you look at the weekly chart, okay, the pattern is still ongoing. So I expect it to test resistance zone 2 at 0.695 to 0.720 going forward. Furthermore, it has already been well supported at 0.590 and 0.600. Okay. So IFAST, most likely, if you can look at that, the head and shoulder is well confirmed. I would say it's confirmed, but the probability of IFAST head and shoulder forming and then confirming its pattern is relatively high. First up, you can see that the right shoulder retest at a lower high, and then bearish candle after a tweezer top. This is a bearish confirmation of what happened to IFAST bearish tweezer top. So hence, I don't think it will reach my target of $9.58, $9.85 if I remember, or even beyond $10 for now. So next major support at 756 to 789 is very crucial. Once it's broken, so you may retreat back to $6.89 to $6.58. The $6 plus region, which is kindly like the mean reversion of all of that. Okay. So another thing is 63-day moving average look like it's going to be tested and then just break down on the outside. Okay. Let's move on to the banks. The banks also head and shoulder type of pattern. So our price actually pull back, has consolidated with a bearish candle, pull back up above the $30.62. But currently, I think price is going to go up higher and then retest and then break the potential head and shoulder and then retest support zone 1 or support zone 2 going forward. So the failed bull trap of the ascending triangle has already proven that this may be the first leg and then a second leg of the bullish wave and then the third leg of the bullish wave. Either support zone 1 or support zone 2 will be a very good price zone to look out for. For UOB diamond pattern is kind of like gone, but although the immediate resistance zone at 26.44 to 26.86 remain like weakened after multiple time of testing. So price actually was kindly well supported at around $25.65 to $25 region. And there is like a bullish reversal today. So this, if you can look at that, this is like a minor double bottom. All right, so if price going to break up 26.32, then we can see that there will be a higher high to 27.37. All right, but if this is rejected, I'm looking at major support zone at 23.51 to 24.24 going forward for UOB. All right, that's what are my thoughts. All right, Jardine, I think most of you are quite concerned about Jardine. Jardine bearish death cross is confirmed. Major support zone at 17.73 to $18.30 will likely to be the major support zone. There won't be any new things going on. Bearish trend is highly confirmed. Despite a bearish bullish Marubozu within the support zone at $19.73 to $20, prices still remain closest lower today. And there's like significant like bullish divergence, but prices remain at a 40 support line of the RSI. So price likely to trend lower based on the technical and price action. Some power. Okay, some power initially I was very bullish about it because of the bullish candle that rebound from the support zone. But however, this consolidation of the bearish candle got me worried, and then I need to know how well some power is going to go. For more detail, you can read my report listed in stocksbnb.com. Okay, so for some power, I'll keep it neutral for now. Comfort Delgro, despite the stronger upside, bearish candles, and then retest of the resistance zone at 1.68 to 1.70 is kind of like a threatening procedure. All right, so price may continue to break up, but it won't survive beyond $1.80. And then if price really do go above $1.80, price will likely have a strong correction down to 1.41 to 1.45 support zone. All right. I think someone asked about Yangzijiang, how it performs. So Yangzijiang actually has already completed the subway 5. So likely we are going to see some consolidation going forward within the next 1 week to 4 weeks. So we shall see how it goes for Yangzijiang shipping. All right. So that's all for now. I'll pass my time back to my colleagues, and then for the next question Q&A. Thank you.
Netlink, can you do the capital DC? Yeah.
Okay, Paul.
Okay, so before you start, let me just answer this question. Thanks for your question. With such low daily volume for Koda, is it still a buy even though the business is improving? There are many days without any trade. Please kindly review all the counters. Focus on top trading counters in Phillip, at least to benefit of more. Yeah, thanks for the feedback. Okay, and anyway, for these two particular counters, the reason, I mean, even later will explain on the buy call. The reason why you will notice we cover quite a bit of the small, low volume is because of the MES scheme. So don't blame us. I shouldn't blame MES. But anyway, if you read the reports, right, at the bottom, a lot of the small caps that we do is under the MES research scheme. Because we were to participate in this scheme, we are to pick some of the, they have a list of small cap stocks where we're supposed to cover. So these are the ones, so we have to pick at least hopefully so we didn't really look at the volume. For us was more, the fundamentals were strong. So that's why we had to do these things. So you can look at the report, that's why you notice, well, how come we cover those that the volume is very low. I think likewise for Yoma, I mean, the volume wasn't that low in the past, but anyway, this is the reason, because we subscribe to this scheme. So we have two analysts under the GEM scheme. So that's why all this. Yeah. Okay, over to you.
Okay. Hi. Okay, sorry. Yeah. So the first question is about can you comment on the share price performance of Capital DC in relating to its recent divestment and share placement? So for Capital DC, I think the divestment is the potential divestment of the asset in Brisbane. That one is actually not confirmed. It is a sort of a call. Yeah, so the Capital DC has granted its underlying tenant, iSeek, the option to purchase the data center which it currently leases, which is iSeek data center in Brisbane. And they have a 5 years period or window to exercise this. So this 5-year window actually begins on the 1st of August 2021. Okay. So with regard to Capital DC, actually I also take this question in conjunction with another question that I saw earlier, which is data center supply in Singapore. If it increases with the lifting of the moratorium, which REITs will benefit and which REITs will be negatively affected. So this question also relates to Capital DC because Capital DC it has about 70% of its revenue actually comes from Singapore, and these are assets that are co-location are on co-location leases. Okay, so the story for Capital DC and also with regard to the Singapore data center supply is that the co-location leases in Singapore, which have a WALE of around 1 to 2 years or 2.5 years, meaning to say that it's going to expire within the next within the next 2 years, basically. Because of the tight supply in Singapore, there's a possibility that the rents are expected to be bidded upwards. Yeah, so of course, with the increased supply, that would actually mean that the ability to raise rents might be compromised. That said, even if the moratorium were to be lifted end of this year, you still have to factor in some time for the constructions to take place, and even the soonest in your most optimistic kind of outlook, let's say let's say more data supply comes in, within 2 years, that will actually mean that a lot of capital DC's leases will have been de-risked, meaning that they will have already been renewed. That said, data center tenants are relatively sticky. Upwards of 80-90% of the tenants will actually renew and stay with the current operator. Some of the REITs that might potentially benefit, I know that I believe it's ESR. They are currently eyeing, or rather they have an asset that is undergoing AEI, and they're actually hoping that they could convert this into a data center or partially data center asset. Of course, that would need approval from the relevant authorities, and provided the moratorium on data centers is lifted. Yeah. Okay, so I think I answered that question. Capital REITs, what is the reason for its recent price weakness? For Capital REIT, I believe that the price actually started to trend downwards after the announcement of the restructuring of SPH. So with this restructuring, what's going to happen is SPH, because Capital REIT is currently 46% owned by the sponsor, Capital. So as part of this restructuring, they're actually going to reduce the amount of stake that they hold in Capital REIT from 46% to about 20%. So I guess this could be a bit of nervousness with regard to the stock being not so closely held anymore, and perhaps that could imply more volatility for Capital. Operation-wise, I think pretty much the same. The office sector or the office assets still face a little bit of stiff competition with regard to there's still some downsizing and consolidation within the tenants. So that I think of course that is stabilizing, and the office rents of course are showing some strength of as mentioned, the CBRE rents have stabilized quarter on quarter. Yeah, and yeah, okay. So that is about Capital REIT. I think there's another question for me below. Okay, how has S-REITs responded to rate hikes in the past? Is there a pattern or actual response ahead of the rise? Okay, so for REITs, yes, there actually is a negative correlation with regard to interest. So for the REIT share prices, actually they're inversely related with the interest rate. So if interest rate goes up, then the share price will actually come down. Yeah. Okay. Yeah, and there has been this kind of historical pattern or trend, if you will. And for so when we look at it, we see that the interest rate levels, as I mentioned, for the 10-year, we look at two interest rates. So first of all, of course, is the 10-year bond yield. That will give us the yield spread. So meaning to say, the yield spread that we will have under, if let's say the interest rates was like 2%, so the yield spread probably will become narrower because you're minusing off the bond yield. So as the bond yields reduce, then the yield spread could actually expand. Yeah. And another interest rate reference we take is the 3-month SOR, because that actually affects the borrowing rates for the REITs. So currently the borrowing rates for the REITs are actually 0.19%. It is actually way lower than what it was even like three years ago. So what this means is that it actually provide the borrowing cost for the REITs is lower. So that will actually make acquisitions more accretive for REITs. So we still have about until 2022, 2023, where we start to see the interest rates start to creep upwards, especially for the 10-year yield past 2%. And so as you can see, the REITs are actually quite aggressively trying to rebalance, reconstitute their portfolio. A lot of them have actually purchased assets yeah. And that will of course help the DPUs to recover faster. And they still have a bit of a window here to capture this more favorable interest rates. Okay, another question. Is there a specific reason why PHSR is not covering the fundamental analysis of REITs linked to sponsor Mapletree Investment Private Limited? and also these REITs are part of the STI constituents. Thank you for this question. Actually, yes, we do hope and intend to increase our coverage, especially we know that there has been quite a lot of following for the Mapletree Commercial Trust or even your Mapletree Industrial Trust. This is an issue of resources. Yeah, we'll try to we'll try to review our coverage and see if we can add some of these Mapletree names to our list. So thank you for the question. I think that's about it for me. I'll hand over the time to the rest of my colleagues for now.
Netlink, there's also the digital realty possible IPO, is it? Can you
So for digital realty, they are also eyeing an IPO in Singapore. So I believe the initial portfolio is about 10 data center REITs, but they didn't specify the location of where these assets are going to be. They just say they have a global mandate. So that, of course, that might also, some of the investors might also be holding on to some of the cash in case this IPO really does come online. Yeah.
But the digital realty, just to remind, this realty is big. I mean, you go to the website, they got like 200 REITs out there. I don't know how many they own. Maybe they just manage, but they have like a portfolio of 200 REITs. Data centers compared to Capital DC, I mean 20, is it? I'm not sure. Yeah. So this is a huge company if they do get listed. So that could be an overhang. Again, we have no idea what's the status of this IPO, but that could be one of the reasons for that overhang on Capital DC. Possible, I'm not sure. Okay, thanks. Let's move on.
Hello, Vivian here. So thanks, Paul, for the clarification earlier. And maybe I will take the two questions on the report on Koda released this morning. So the first question is, under Outlook, it was mentioned that we expect export sales to continue growing on the back of work from home with renewed virus containment efforts. How long is the growth of the export sales expected to last? As I noticed that in your report, the FY22E revenue is actually lower compared to FY21. Yep. So for the sentence on expecting export sales to continue growing, the work from home renewed virus containment efforts. This is referring to the US market. So with that, we are expecting that, as you saw in the presentation earlier, the graph on the US furniture imports, even though it's slightly declined for June 2021, but it's still substantially above the pre-COVID levels. So this is referring to the continued strong demand for furniture imports from the US side. Yeah, but for FY22E revenue, it is lower we are forecasting a lower revenue compared to FY21 due to the fact that they are experiencing production disruptions at the Malaysia and Vietnam manufacturing facilities. And of course, if you cannot produce, then you also cannot export. So that's the reason for that. Yeah, hope that clarifies. And the second question is, under other updates, it was mentioned that Koda has entered into an agreement to purchase the 18 Tagore Lane in Singapore. Any idea how would this purchase be funded and how it will affect the bottom line? I noticed that there is a 10.2 million bank borrowing in FY22E. And has it got anything to do with the purchase of the building? Yep, so thanks for the question and thanks for noticing that. So they announced this agreement, entering into this agreement to purchase the industrial building due to the fact that the current industrial building that they have or they are occupying is at Defu Industrial Park, and it is quite old, and the lease is actually due to expire by the end of 2023. So with that, they are actually terminating, if you refer to the report, they are actually terminating the lease before the expiry. And to replace that space that they occupy, they decided to acquire this freehold industrial building in the Yio Chu Kang area for 11.2 million. So also in the announcement, they mentioned that it would be financed or funded by their internal resources and bank borrowing. So we are just estimating about a 10 million increase of borrowing, yes, for funding the acquisition of this property. So this building, the old building or the current building at Difu Industrial Estate is used for its corporate office, furniture showroom, and their workshops and warehousing. So basically it's just moving everything over from the old building to the new building, which is also more modern and more modern. So that wouldn't affect the bottom line in general, because it's not like production capacity expansion, which they are doing in Vietnam. It's just shifting over from an old facility to a new facility. Yep. Hope that clarifies. And if you got any further questions on Koda, we are also having a webinar with them on Wednesday at 12 p.m. So yeah, could sign up for that. And just a quick one on any updated view on LHN. So LHN, not really updated views, maybe just to reiterate again. So for the space optimization business, which contributes around 50% of the revenue, for the residential properties, the subsegment, they announced they had two announcements in July regarding the acquisition of the properties to expand the Koliu segment. So that would add about 60 keys to the portfolio. And also for industrial properties, we also continue to see growth in the e-commerce, with the percentage of e-commerce contributing to the retail sales increasing for June 2021. So for them, the growth is still very strong. And yeah, that's all for LHN. And that's all for me for now. I'll pass the time on to the rest of my colleagues.
Yeah, but I think the thing for Koda, I think when you go to their showroom in Singapore, I think Vivian can tell you that the demand for furniture is very strong now. Even in Singapore, they got a waiting. I mean, there's like almost like a waiting list, because everyone is now stuck at home, as you all know. Gym at home, everything's at home. So the propensity to change furniture is higher. But of course, the unknown is 12 months time, 24 months time. Of course, we will never be clearly know how long this will trend. But we think one of the offsets will be they will go more into sofas, and they're also expanding capacity. So that could be offset. But again, this will be the questions that we will also be asking them when we do the webinar. Is just the sustainability, because this is change in consumer behavior. Is this just a one-off? Okay.
Yep.
Yeah.
Thanks.
Okay.
Yeah, I'll take the next question in the queue. Your view on Keppel Corp, please. Thank you. So for Keppel Corp, in their latest quarter results, the first half 21 results, all of their operational segments will actually outperform our estimates. If you talk about the offshore and marine business, that is already EBITDA neutral. And they would have actually turned positive, net profit positive. They just suffer. That's a very small $100 million loss. So in terms of for Keppel, in terms of their O&M segment, that's performing well. In terms of the property business, that improved on a 26% year-on-year basis, because their home sales in China and Vietnam, that's why all the controls and COVID-19 restrictions affecting the home viewings, but the property business was doing well. And also, even the asset management business was doing well, because they achieved record AUM in their last quarter. The only business that lagged for Keppel was the connectivity business, and in the connectivity business, there's M1 inside there. If you look at our coverage by Paul on Singtel and Starhub, you know it is an industry thing. The roaming charges the roaming revenue is down, obviously, because of the lockdown and curbs. So almost all of Keppel's main operations are firing on all cylinders. So they accept the connectivity business, which is good for Keppel. In terms of outlook for Keppel, though, the main overhang for Keppel at this moment, obviously, is the two transactions which they are currently pursuing at the same time. The first is the spin-off of the Keppel O&M business to Sam Marine, and then the second, which they expect to, and that transaction they expect to complete by or at least to have some resolution by the third quarter of this year, or fourth quarter, and then they hope to conclude this by December this year. It's the same for their proposed acquisition of SPH, the SPH unit without the media business. So if these two transactions take place, it will remove, we think, the overhang on capital, and we could see a re-rating on the company. But until we have news on their O&M business and the acquisition of SPH, it could remain a little bit, it could go sideways because of the uncertainty with regards to what will happen to capital. So I hope I answer your question. If I didn't, you can please just let me know. The next question is, can you share your latest update on Sembcorp Marine, your view on what its future will be like? So we don't have any coverage on Sembcorp Marine, but in terms of the near-term outlook, for Sembcorp Marine remains challenging because even though oil prices have risen in the last year, but this has not distilled down to higher expansionary capex from the oil majors. So when the oil majors are not spending such capex, then it means Sembcorp Marine is not getting all of these contracts also. So in terms of for full year 2021, they are still expecting to make a very significant loss. In fact, when we look at their first half 2021 results, their first half loss is already the same as their full year 2020 loss. So that tells you the magnitude of their loss. Other than the revenue front, the cost front is also challenging for the group because the manpower cost continues to be really high. They have, but this is a sector-wide thing. They continue to face challenges bringing in foreign workers and fulfilling those contracts. So the outlook for Sembcorp Marine, at least in the next 1.5 years to even 2 years, will continue to be challenging. Of course, for investors taking a longer term view, and I think that's how at school I saw a question on whether investors should subscribe for the rights issue. The answer is, if you are existing shareholder, it's recommended to sign up for rights issue, otherwise you'll be diluted. But investors for Sembcorp Marine, it's always been our view that you need to take a very long-term view of Sembcorp Marine, because in the near term, it will continue to be challenging. But but they're pivoting towards they're tapping on this energy transition and tapping and going into this renewable energy. So if they can go into that space, but don't forget also that space is very competitive also. It's not like there's no one there also. So if they can transition there, then the outlook for them should improve. So I hope I answered your question. Maybe then should you buy their rights? I have some shares of Sembcorp Marine. Should you buy their rights issue to reduce loss? Not really not reduce loss, but I mean you obviously will lower your overall the cost of your Sembcorp Marine shares, and also at least then you don't get diluted. But you do need to take a longer term view. One of the house view we have also is that because Temasek has an offer kind of waiver, what they do is they buy the shares at 8 cents. So what happened is that there's a theoretical floor for Sembcorp Marine price at 8 cents. So what some people will do is they try to buy a little bit, and then they will subscribe for a lot of excess rights issue for Sembcorp Marine. And the reason why is because the market is kind of supporting the price at 8 cents, right? So so there's some cap there in terms of downside in the near term. Yeah, okay. I just scroll down and see if there's any more questions from me. Yeah, I think that's. Oh, sorry, there's one question here. Will Sembcorp Marine shares be consolidated because there are so many shares outstanding? Not that we know of. In the near term. Yeah. Yeah, that's all for me.
Okay. In view of time, I'm not sure to answer the OCBC one, but let me just do a quick one on UG. UG can buy since they give handsome dividend. The dividend was opposite or handsome, so you know what's opposite handsome. It was only, I think the yield is only 1%. I think they're saving out a lot of the cash for their expansion. This is not commentary from UG because we haven't released the report, but commentary from Riverstone, from Hatta Lega. I think what's happening in the rubber gloves industry, I think for those who are not updated, is that the prices are coming off. I think prices are coming off almost 20-30% month-on-month. That's number one. The reason is because the inventories, because prices peak in February, March, and a lot of the distributors do not want to hold the inventory because you're losing money. I mean, you order now, then 2 months later, the price come down. So as a result, there's almost everyone is just buying to demand or only weekly buying. So as a result, now you see this rubber prices starting to slip quite sharply. And of course, the third thing is, the other issue is not issue, but the other challenge now, you have the Chinese manufacturers coming into the picture more aggressively than before. I mean, Chinese manufacturers are focused mainly on nitrile. So these are some of the challenges now being faced by the rubber glove industry. But we'll release the report because we just had the conference with them. Okay, thanks.
Okay, sorry, I'll just take one minute of time to quickly take something first. There's a question on CICT. Any impact on the CapitaLand partial privatization of CLI? So just as a recap, this demerger of CapitaLand, the consideration would be partially cash, 95 cents, as well as some CICT shares and 1 unit of CLI, which is the new entity that will be listed soon. Okay, so for this, for the CLI, for the CICT portion, the amount of the exchange or rather distribution in specie of CICT shares, the amount that will be released from CapitaLand's holdings actually is about 5%. So according to the management, this should not really impact the trading of CICT that much. But that being said, of course, there are some investors who might not have such a positive view on the retail or office sector, and so that there might be a bit of selling down. But so there's about 5% of units that will be paid out in shares. Okay. Also, there's a similar question, which is which would you prefer, CICT, which is a diversified office and retail REIT, or a pure retail such as FCT? So okay, for those REITs with office component, be it core CBD components such as your Keppel REIT or even CICT or MCT, which has more of a suburban kind of office product type within the REIT, regardless whether it's central or suburban office, there has been a little bit of there's a bit of headwinds for the office sector in general. Yes. So, I mean, of course, the share price for CICT is also relatively compelling. I think if you look at the prices, or based on our forward estimates for CICT, we are expecting an FY21 dividend of 4.9%. For FCT, it's about 5.3% forward dividend yield for FY21. And in terms of total return, including the share price, including the capital returns that we are forecasting based on our target price, CICT versus FCT total returns would be 27% versus 29%. So that being said, of course, I think we favor the suburban retail because of course they have been relatively resilient throughout the cycles, even when if you look at before COVID, there was still, when people were still going to work, then there will be a lot of transient footfall, which means people bypassing the MRT stations and the interchanges, and so even as we pivot, and of course during COVID, where most people were trapped or rather working near home, so that increased the daytime population. Even if we transition back to more of a work from office kind of mode, then we will expect that the daytime population, at the suburban daytime population will be then translated into transient footfall, which will then lead to incidental spending whenever people, pass by the malls on the way to work or back from home. Back from work. Yeah. So I think overall, with regard to office, So that's how it answers the question with regard to like a diversified mall, diversified REIT where there is some office component. There's still a little bit of caution because of the sort of weaker leasing, which has been improving quarter on quarter, but is still comparatively weaker. And so I would prefer a pure retail, such as your FCT, in favor of a diversified REIT, which has both office and retail. Yeah. Okay, I think that's all for me. Terence, if you want to take any last question.
Yeah, because of time, maybe I'll just quickly rush for this question. Sorry, I missed out the OCBC. I thought it was a TA question. But what is the price expectation of OCBC? So in our last quarterly results, we actually lowered the target price of OCBC. The reason why from 1463 to 1422. So we still have a buy rating of OCBC, mainly because of their very strong capital ratio, CET1 ratio is about 15%. So, but in terms of price expectation for OCBC, we think it will continue to be a little bit weak or be sideways, mainly because in the last first half 21 results or second quarter 21 results, they actually tone up their credit cost expectation for the full year of 2021, mainly because of their exposure in the sort of emerging markets in Malaysia and Indonesia. So with higher expectation of GPs that they're going to provide for full year 2021, we think that compared to DBS and UOB, we think that the outlook for OCBC will be a little bit more muted versus the rest of the two banks. Yeah, I think maybe that's all the time already. I'll just see whether the rest on the close.
Yeah, I think in view of time, we probably have to end it because I think Varian has a 1 p.m. So I think thanks everyone for your time. Thanks for all your questions. I know we can't really answer all. There's still a few more. So just send us an email or in our Stocks BNB chat. We will try to reply. Anyway, take care, everybody, and have a good day ahead. Thanks for listening to us and all your questions, especially. Thank you, everyone. Take care. Bye.